So getting back to our PowerPoint example, you can also solve for the dividend yield based on the formula. It is the first year's dividends divided by the current stock price. And it's pretty easy to use Excel to do it. It is the first year dividend divided by the price you just solved based on whichever method. This should be percentage. All right, and then you need to get a capital gains yield. Well, the definition of a capital gains yield is the percentage change of a stock price. You probably need to use the price 1 minus price 0 divided by price 0 as the formula. However, to get price 1, it is very difficult in the two-stage growth model. If you get a price 1 here, you're gonna use dividend 2, dividend 3, and then price 3 discounted by n minus 1 years, so it is unnecessary. So what you can do here to get a capital gains yield is to utilize the equation that dividend yield plus capital gains yield is the total return. Therefore, capital gains yield is the total return minus dividend yield. So your total return is the required return minus dividend yield. This would be your capital gains yield. So you can skip the orthodox formula of a price 1 minus price 0 divided by price 0. You can skip the part of solving for price 1. So that's going to be nice and easy. All right. And here is another example. So what about the growth rate is 0% for the first 3 years and then 6% thereafter. So it's just like what we did with our assignment. So change the first stage growth rate to 0%, drag it all the way down, and then it grow by 6% thereafter. So the price today is 25.72. All right, there's some rounding issues by 1 cent, but it's okay. Okay, and here's a dividend yield, here's a capital gains yield, so this could be tested. You don't have to solve for price 1 to get capital gains yield. You don't have to utilize the formula of a P1 minus P0 divided by P0. Instead, you just use the total return, which is given, minus the dividend yield. Of course, the dividend yield could be negative, so we just follow the same principle and to solve the problem. And here is the second model I want to mention in this video, but I'm not gonna go into the details for this model because it's gonna be covered in later chapters. This corporate valuation model applies for the stocks that do not pay dividend, like Facebook, like Microsoft before the year of 2003. They did not pay dividend at all. But still, the company stock value grows larger and larger. It's because the company is making profit. So the profit we use here is called a free cash flow. Okay, FCF stands for free cash flow. And that is the operating profit, EBIT, times 1 minus tax rate. So this is the after-tax operating profit. And we're going to recoup the non-cash effect from depreciation and amortization, and I have explained that in previous chapters. And of course, the company is going to spend money to buy equipment, land, plant, property. That is called a capital expenditure. So it's going to be subtracted. And also, there's a change in net operating working capital. So net working capital is current assets minus current liabilities. And a part of the current liabilities is related with financial securities that is not operating. So we're going to exclude those financial liabilities from the current liabilities. So to get net operating working capital. And it is also important, it is the change of net working capital. So if the net working capital does not change, there would be no cash flow effect. So only when it changes, like inventories increase, that means you spend cash to build the inventory. So you should subtract that amount of cash from your free cash flow calculation. And the details will be covered in chapter 10, 11, the capital budgeting chapter. And this would be the cash flows we need to discount. This would be the future cash flows we need to discount. And here is a layout of a fictitious stream of cash flows, free cash flows, generated in the next years. In year one, you had a -5. In year two, you have 10, 20 in the third year. And then starting from year four, we assume a constant growth rate at 6%. And we still use the same old technique to solve for the stock price today, except that this time the cash flows are not dividends, but are free cash flows based on this giant formula. And the discount rate is not actually the required rate of return by the investors, which was used to adjust the risk level. It is weighted average cost of capital. The weighted average cost of capital will be covered in Chapter 9, so I will not spend too much time here. Just for your information, just to give you a very simple example. If all the money the company uses is a loan borrowed from a bank at a 10% interest rate, then the cost of capital is 10%. Since it's all debt financed by that one single loan, then there's no weighted average, or the weighted average cost of capital is just the 10% loan interest. All right, so this is how we do the calculation. You can do this practice at home by yourself. And another easier case is a preferred stock. So preferred stock, as I mentioned earlier, keep paying the fixed amount of dividends across years, and you are going to discount it with the same required rate of return, but this time it is for preferred stock. It's not for common stock, because preferred stock would be safer than common stock, so the required rate of return would be lower than the return for common stock. And you still use the perpetuity model. This time you don't need to use the growth rate. You don't need to there's no growth for dividends, and you just use, or the growth rate is 0 for the dividend, and you just use the cash flow divided by the return. The two models I mentioned earlier were about stock valuation, and if you use these valuation models, what you get is the intrinsic value for the stock price, or the true model, or the true price. And this is based on our theoretical approach, and that is where the equilibrium should be. However, in reality, the stock price could deviate from the intrinsic value because the investors have different perceptions about the stock market or a particular single stock, and their perception would affect the stock prices to deviate from the true value. And sometimes the stock price could become overvalued, and sometimes it could become undervalued due to irrational or wrong perception of the investors. So here we have the stock's intrinsic value determined by the true cash flows generated from the firm or the stock, and the true risk estimated according to the feature of the stock. And how to estimate the risk, it is in Chapter 6. However, in the market, the investor perception really plays a big role, not only in the perceived cash flows, but also in the perceived price. In a normal situation, intrinsic value is not quite different from a stock price, but things could happen. There could be some exceptions. And right here, I'm going to introduce you the efficient market hypothesis. This is introduced by Dr. Eugene Fama from the University of Chicago and Dr. Kenneth French from the University of Dartmouth. And this model helped Dr. Fama won the Nobel Economic Prize in 2015. So in this model, we see that the market efficiency is a hypothesis. So what does market efficiency mean? That means the stock price reflect all available information, and this information would be called material information that is related with firm's earnings and the risk level. If anybody have a material information, and your decision would be different if you have more or less material information. If you have a positive information like good earnings for the year, then investors would buy the stock, so there would be a lot of buy orders in the market. The stock price would increase. If there is a negative information like financial scandal of the firm, then people would dump the stocks, sell them, the price would decline. So that's pretty straightforward. And an efficient market basically means the price reflect all the information, positive, negative. And we can possibly have a perfectly efficient market. And in this perfectly efficient market, no information advantage of any traders over another group of traders. So basically that means everybody knows everything. And then the stock price will be at the right amount. It will be right there at the intrinsic value. So the buyers pay a fair price for the stock, the sellers or the firms receive a fair value for their securities. However, perception matters. Like right here, I'm not sure if you guys watch the European Cup. When the soccer star, he is one of the highest paid soccer star, Cristiano Ronaldo, removed Coca-Cola bottles from his desk in a press conference after a game, the Coca-Cola stock price plummeted by certain percentage. Do you think such a move would affect Coca-Cola's earnings of the year? A little bit, maybe not, but it's really investors' perception about Coca-Cola that to change the stock price in such a short amount of time. And in the efficient market hypothesis, if new information arrives, prices would move to the new equilibrium very, very quickly because there are so many smart traders and smart analysts looking for mispriced securities. If the securities are overvalued, they would sell the security or short sell the security. If the stock price is undervalued, then they would buy the stock and make the stock price increase. So the price would get back to the right level. And that means the mispricing of either overvaluation or undervaluation will be immediately corrected. Now let's look at what types of information all these smart traders use. One type of information is called historical prices. So you just look at the past performance of the stock. This is the stock price for, this is the price chart for Google. As you can see, the price level just fluctuates and the normal trend is going up. So if you look at stock prices, you would need to detect the trend and also the cyclical patterns. Fictitiously, if you look at a stock price performance like this, then you know it's going up and going down and has a upward trending. So what would you do? You could be a momentum trader in the long run because over a longer time period in the past, the stock price is going up. So we assume the stock price will keep going up in the future. If you're a momentum trader, then you would buy the stock because you assume the stock price is going up. But if you trade for short term, as you can see, the stock just reached another new peak. So it could go down in a very short amount of time. Then you, instead of buying the stock, you would trade against the current trend. You see the current trend is going up, but you would sell the stock because you think it will go down in the short run. And in that case, you are a contrarian trader. Another type of information is public information issued by the companies, the press, and even the government. So you can check the company's financial statements. You can also watch the news for the merger and acquisition, all these events, and also the new release of a product by a company. So this would definitely affect stock prices. And another type of information is called insider information. And if you know insider information, believe me, you can still make a profit. However, that insider trading is illegal. If you conduct insider trading, then you will violate the law and you could be arrested for that. This person is Mr. Ratnam. He was the head of a hedge fund called a Gallon hedge fund, and he conducted a lot of insider trading at that time. And insider trading, of course, you need to have somebody, some friends that has insider information. They could be a manager at higher level, or the press, some journalist, or the government that has connection with the companies. What this person did was he had an insider friend called Gupta. He was a Goldman board member, and he tells this Mr. Ratnam that Warren Buffett will invest $5 billion in Goldman. That is a positive information. When the market learns about it, the price will go up. And he learned this before the market knows it, before the public announcement. He learned it from his insider friend, and he purchased the stock before the announcement of this information. And when the next day Warren Buffett made the announcement, the share price jumps and he made a profit. And another case is about selling the shares. Still, the same insider friend tells Mr. Raj that the company's earning is pretty low, so he just sell. So Mr. Raj receive this negative information and then just sell the stock before the market learns about it. So he avoid losses. So selling by insider information is just as bad as buying on insider information. So the lesson here is don't do it. We're in Chicago, and there are a lot of public traded companies in Chicago, and you may have a lot of friends or relatives in Chicago, and you will come across with certain conversations about their companies. So if you hear about some insider information, you should not trade on them. It's okay to have fun with them, to have discussion with them, but you just cannot trade their stocks, their company's stocks based on the insider information you received. Here is one trading technique called short selling. It is the way to profit from stock decline. Short selling in the security market is different than short selling in the real estate market. If you do a short sale in the real estate market, that means you are selling your house below the value of your mortgage. But in the stock market or bond market or even futures market, short selling means completely different things. If you do a short selling, you borrow the securities, for example, the shares of stocks from a broker today, and then you sell it right away for cash. So today you have a cash inflow. And later on, you need to return the shares to the broker you borrowed from, and you are going to buy the shares from the market and then return the share to the broker. By doing this, you hope that today the stock price is higher than the price later. That way, you can receive more cash flows today and spend less cash flow to buy the stock later. So this is how you profit from the price decline. And of course, if a price later gets higher than today, then you would have a loss. You probably have heard about the recent stock frenzy about GameStop. So GameStop is a company that didn't do very well during the pandemic, and the Wall Street expect the stock price to decline in the future. And they have solid information supporting that expectation. If you check GameStop's financial statements, and they did not do very well, their profit became negative over a quite long period. So definitely this is a stock that will become less valuable. So what the Wall Streeters did was they short sell the stock, and they also make announcement of their position that they have a short sold the stocks. The Wall Streeters were thinking that if everybody knows this stock sucks, then they will all sell it, so the price would decline more, and then as short seller, they can profit more. So that's their plan. However, there are a group of people that are against the Wall Streeters. From this chart, you can read this chart when you have some time. So what happens here is they basically a group of individual investors against the Wall Street people organize together, and then they keep buying the stock shares. So when the individual investors buy the shares, and this is a small stock, so it doesn't take billions and billions of dollars to make the price change. So that is a loss for the short sellers. And the more the stocks the individuals are buying, the retail people are buying either using Robinhood or E-Trade, and they are organized through social media called Reddit. These are all Reddit users that are against the Wall Street people. So the short sellers eventually abandon their position, facing the potential losses, and when they clear their short position, they have to buy back the shares and return to the brokers they borrowed from. But it's hard for them because the price just became so high. So they have to eat the losses. But of course, such behavior by the Reddit users lack financial fundamentals. It's more like a market manipulation, or it's more like the common villagers storm the castle or a communist revolution. There is no financial foundations behind that. So when the stock price ballooned from $20 to $350, then it tumbled right after because the perceived price, the market price, just deviated too much from the intrinsic value of the stock, and then it will get back to normal. And this could be suspected for market manipulation behavior, and what the Reddit user did and their leader were suspected by the Securities Exchange Commission for manipulative trading behavior. And this example is a good example to show you how the market price based on investor perception would deviate from its intrinsic value. It could also show you how the short sellers profit. Actually, in this case, they lost. The stock price goes up. At last, we want to know, why do we buy stocks? If you look at a stock 100 years ago, it's a stock certificate. It doesn't have a due date, and you can receive cash flows from it, or you can receive dividends generated by the stock. If you don't receive dividends, then the stock still has value because the company makes money and the profit belongs to stockholders. And the stock is on the financial statements, in particular with the common equity for shareholders. And when you buy the stock, no matter how few shares you purchased, you are an owner of the firm. And it is equity. And equity indicates ownership. If you buy the bond of the firm or lend money to the firm, there is no ownership involved. And if you have the ownership, you can vote. But if you're just a creditor of the company, you cannot vote. In terms of cash flow, if you invest in stock, you receive dividends. And the dividends is from net income, which is after tax. And if you invest in bond, you would receive interest. And interest expense is before tax. Therefore, interest expense is tax deductible for the firm. In terms of a priority of a cash claim, the creditors of a debt would have a higher priority for the interest payment, and interest payment and or principal payments cannot be missed unless the firm bankrupt. But for stockholders, the dividends are not a liability of the firm, and if there's no dividend paid, there's no legal action you can take. But for a firm with a debt, it can get bankrupt, but for an all equity firm, there's no bankruptcy because the definition of a bankruptcy is an individual or a company unable to pay back its debt. Once there's no debt, there's no bankruptcy. There's also preferred equity, and the preferred stocks is also available in the market. So preferred equity is like a hybrid between common equity and corporate bond. They have a seniority in dividends payment. They will get paid first before common equity holders get paid. And for the dividends, they also receive fixed amount of dividend, just like the interest payment of bond holders. But for common equity holders, their dividends is not fixed. And if the firm gets bankrupt or get liquidated, the preferred equity holders get paid first. Actually, they get paid second. It's before the common equity holders, but after the bond holders. And the preferred equity could be demoted to common stock, but for common stock, they cannot be promoted to preferred stock. If you're a preferred equity holder, there's no voting rights involved. It's more like a debt in disguise, but it's called equity. Compared to bonds, preferred equity does not guarantee payments, and also it is subordinate to bonds in terms of cash claims, like the preferred dividends is after interest, and also in the event of assets liquidation.